and welcome to the Trading Bell. So much has been happening in the markets, and we just want to have a view from the asset management side of things. And we have a conversation with Advocarp asset managers, and I have the team here. I have the two co-founders. I have Mwaniki, co-founder and CEO, and Wilson Wariari, co-founder and CIO. They're going to help us to understand what's happening really on the global side of things, on the macros, here locally as well, and what else are they doing as Advocarp to especially help investors in their investments journeys. Welcome to the Trading Bell. It's good to see you, ladies and gentlemen.
Thank you. Thank you.
Glad to be here at Advocarp offices.
Karibu sana.
Let me first of all start by endearing our viewers on who Advocarp is and what you do, and then from then we can dive into the conversations about what's happening in the world of investments. Let me start with you, Monica.
Thank you. Thank you so much. And just to tell you about Advocarp, we are a fund management company that is trying to bring a different view around investing in funds. And this is to mean that we have a wealth management focus. We are looking at how do we help investors, even at a personal capacity, or at a group level, or at a family level, at a business level. How do you use the CIS platform to enrich your portfolio, to grow it, to ensure that you're not losing value? You realize that this capital market is a space where every other day it's growing, more products are coming up, sophisticated products that require specialized skills, yet investors may feel inadequate to perform some of this research and be able to identify where the opportunities are. But that's where we come in and help them, not just to give them advisory, but to also execute for them. This is our second year in operation, and we've been able to give quite good returns to investors, and I can say that we are looking forward to a long journey with our investors.
I love that.
Yes.
Good returns are good things for investors. And Wilson, let me bring you in as well. And I'd like to start with you from the end of looking at how the environment has been, especially from the global perspective, and probably you could also tell us what's happening around us as well. Over to you.
At the macro level, this year, looking at the global markets, it's been a year of uncertainty. From the beginning of the year, mostly led by tariffs and the expectations of what tariffs will mean. The market, even as we started the year, there was now the talk of the inauguration of the new president in the United States and his push towards tariffs and what that would mean to the global markets. We saw that being implemented from Feb to April, when we had now the universal tariffs. So that ratcheted the markets a bit. But then there was a pause on the same, gave a 90-day reprieve to the global markets. And what you have seen is that we have seen that cyclicity in the market this year. Market has been reacting to these new policy directions and what tariffs will mean to the markets. And most of what we have been looking at is inflation. Because all this means is that, one, access to markets. Will the countries that have that tariffs have been imposed on their products, will they still manage to access these markets? And US is one of the largest markets, consumer markets for a lot of producers across the globe. So you still have access to that market. So that's one. But then on the other side, from a US perspective, is what does that mean for inflation? And we really see ourselves back to the 2022 levels where we had skyrocketing inflationary fears that really dampened the market more then. So this year has been more of that policy shift. A lot has been moving. More policy action has happened this year than previously, probably the last few years. But then on the other hand, as we began the year or from late last year, monetary policy was a key, I would say was a key component of global markets. That has taken a bit of a backstage because what we have seen is that some of the global central banks post their rate cuts in anticipation of trying to see what does this inflation mean, what will they impact in terms of their policies. So you've seen like the Fed has not cut rates since September last year. the expectation that they may cut twice before the end of the year. What that means in terms of global capital flows.
Okay.
When you come to the local markets, it's been a great year on the macro front. One, when it comes to monetary policy, we've seen CBK continued to cut rates, and the markets responded. From your fixed income products, you've seen the yields really come down. Then on the other side, that also supported investor move to risky assets or equity assets. So you're seeing the rally that was there towards the end of last year in the equities market has continued this year in the local markets. Something else that has been quite supportive is the growth in foreign currency reserves. We've seen it go to an all-time high of $11 billion. So it's been a great year on the macro policies, the local macro policy or monetary supported monetary policy. On the fiscal side, we have seen the main issue has always been paid-in bills. We have seen the government take a bit of action to repay the paid-in bills, especially they have started on the construction sector, which had the highest level of paid-in bills. We've seen securitization of levies on oil, and that has gone to pay from the latest cabinet dispatch. We saw 40% of the paid-in bills have been paid. They have authorized payment of another 40%. So that one also now basically supports monetary flows or flow of capital within the economy. So it's been a great period, a bit mixed on the global scale, uncertainty on the global scale, a bit more stability in the local markets. And so now from here is now the transmission mechanism. Because at the end of it all, it's whether it gets to the end consumer.
You're right.
So I think that's the stage we are in now.
That's a good one. Monica, let me bring you in as well, still in the same breath, because we have also seen at the exchange especially, there's been a great rally, especially on the equity markets, the bonds market, and I'm sure there's a perspective that has been built by Wilson as well. What can we make of it?
As you have heard the CIO explain, that for sure both the monetary and the fiscal policies have really supported the market. And we have seen a shift between the two asset classes. These are the bonds and the equities. And then again, I'll bring another aspect of post-COVID. This is the time now we are starting to feel good recoveries in the market. And most of the stocks have reacted to this. Something like the lowering of the interest rates definitely has spurred and supported business when it comes to lower rates of lending. Markets responding to we've seen growth in the market, and the demand by consumers is also there. So what we have seen is stocks, especially when you look at across the range, both the banking, the FCMGs, and all that, they've really grown, and we have seen a lot of activity. This year, we've also seen a lot of clients jump onto this side of equity funds. We do have both fixed income funds and the equity funds. And we've seen investors now are more, their appetite has increased when it comes to equities. And I'm sure you, on your desk, you've seen a lot of activity on the stocks.
I think it's shift in settlements. Because as one, we coming from a period of really high interest rates the last 2-3 years. That incentivized a lot of clients who are out of the capital market to start looking at the capital markets again, especially buying bonds. But then as rates have been coming down, so investors now are looking, okay, what's the next best alternative? Then they meet very highly discounted stock market. Market has been, even from a peer comparison, we are trading at very low multiples. So it's quite a discounted market. And so therefore, investors were quick to jump in and take advantage of these discounted discounts in the market. So that has seen a bit of a rally in the equities market. So it's been a bit of a sweet spot, if I may say so, especially for the equity investors this year. And
What's your forecast? I'm curious to know, because we are very much excited as well. I mean, investors are happy. And I mean, it started off, when we look at last year coming to this year as well, it's been going. Do we see this going on for quite some time in your own forecast?
There are two ways to look at it. One is investor participation.
Yeah,
I'll say there's still a lot of investor appetite. Still high retail participation and increasing retail participation in the market.
Yeah.
That will drive liquidity. Then on the other side is in terms of valuations.
Okay.
From a value point, yeah, we're still trading at good discounts.
Okay.
And so that means that there is still a leg room. There are a few things that I would say have been a bit of, and investors are probably waiting. This may be one of the most watched earnings season by a lot of investors.
Okay.
To see some of the things that have been, investors have been putting as, they have been there as hiccups to more market expansion.
Okay.
From non-performing loans and such, whether that risk has abated a bit.
Okay.
So, yeah, but it's still trading at good discounts. So, yes, there's still potential for more growth.
Yeah.
Monica, you have something?
Yes, the other point I would want to add is definitely, even as he's saying, maybe in the short term, we can be able to predict that we still have leg room.
Yeah.
But how can an investor be able to anchor themselves in the markets for the long term? Because
absolutely.
Remember,
in fact, you've just preempted my next question. Let's advise investors. They're waiting to know.
Because markets will have ups and downs.
Yeah.
That's the volatility. And this is where clients really lose out their capital. Because yes, some stocks, as we are saying, some bonds may be a good buy by themselves. But then when markets turn, investors are not on time to know when to exit that position and get on to the other one. And that's what we are bringing to the market, whereby we are saying that capital markets are good spaces to gain and build on wealth.
Yeah.
But then what's the strategy you're going to use so that you don't pour as you're adding,
That's true.
Yeah. So you want to ensure that what you have done, you've crystallized your wealth over time.
Yeah.
So at a fund management level, at Advocarp, that's what we do. By actively watching these spaces, if it's like the equity funds, we have an active approach towards these stocks.
Yeah.
We take positions at the right time, exit at the right time.
Yeah.
Times we are waiting to see, and then getting on to the next move. If it's like the fixed income side, you realize there's a lot of capital gains when it comes to active trading of these bonds. And that's what we've been doing with my team here to ensure that we are not just showing a rosy position when markets are really up, but even when they are down, there is what we are doing to preserve and to ensure that we don't erode the capital that they've gained.